Welcome back, investors, to Ticker Time News. I'm Adam, and the S&P 500 has been on a roll, up for 6 months in a row. It's up about 19.5% year to date. But the big question that we need to ask ourselves about the S&P 500 is the S&P 500 getting ready to pull back? Well, that's exactly what we're going to talk about today. Now, before we get into this, there's 3 things that I would love for you to do. Smash that like button, share this video with your friends, and click subscribe to join our family of investors. Those 3 actions are greatly appreciated, and they go a long way in helping our channel with the YouTube algorithm. Now, let's get back into it. The ticker symbol for the S&P 500 that we're looking at today is the SPX. As you can see, there's been a defined ascending trading channel for many years now, and towards the end of last year, the S&P 500 really kicked into gear, setting off its run, creating new all-time highs after all-time highs. But now, we're starting to see some warning signs. A slowdown. This chart shows a rising wedge pattern that's taken shape. Unlike the earlier ascending trading channel that we were just looking at, this pattern is potentially bearish because the new highs aren't keeping up with the higher lows. This suggests buyers are less willing to push the index into new territory. Last week's candles are another potential issue, highlighted in the black circle on the top right. On the 26th and 27th, the SPX pushed about 7 points above its previous day's high, but then closed slightly below it. A false breakout, maybe? It followed a hanging man pattern the next day. That kind of behavior on the chart is potentially consistent with a top. Next, towards the bottom of your screen, the MACD continues to trend lower as prices make newer highs. This is a clear divergence, which is another sign that the current trend is about to be broken. Something else is that a lot of good news may already be priced in. It's been the best earnings season since 2009, but the outlook for companies, take Amazon for example, raises questions about growth peaking. Economic data has also slowed down. There isn't a lot of confirmation for the bears yet. However, given the slowing price action and fewer catalysts next month, traders may want to be on guard for a deeper pullback. If volatility starts to spike, and we're going to talk about that in just a moment, the pattern here suggests it may intensify. Unlike the pattern since November, quick buying the next pullback may not be the best idea. Now, as potential warning signs continue to appear for the S&P 500, like the narrowing breadth and the rising wedge pattern, now we're going to look at a highly related symbol, the VIX, the VIX, the volatility index, or the fear gauge. The main pattern on the VIX is its mild uptrend since the beginning of July. The S&P 500 made new all-time highs 11 different times last month, but the VIX didn't make a single new low. Next, July 19th's high was more than 3 points above June's high, even though the S&P 500 made a higher low. In other words, the VIX is no longer confirming the S&P 500's uptrend. Similar divergences have occurred before other pullbacks, especially in January and September of 2018. Traders and investors shouldn't reach too many conclusions based solely on the VIX. The VIX is similar to using the MACD indicator, which can show bearish divergence for some time before a pullback occurs. At this point, it's just another potential sign of spreading weakness. What do you think will happen with the S&P 500? Is it slowing down and about to reverse its trend? And if so, How far do you think it will pull back? 5%, 10%, or maybe even more? Now, you, my friend, are totally awesome for staying to the conclusion of this video. Thank you so very much for watching, and I will see you in the next video.